Alright folks, welcome back to my channel. So this video is going to be a little different. It's just going to be a how-to video looking over options and explaining kind of what some of the stuff means. So let's jump right into it. So let's go ahead and look at an example. We'll look at Caesars. So CZR is the ticker on this. Alright, so as you can see, the closing price was $57.07. So if you scroll down and find $57.07, there it is. Alright, so the first thing you have to select is the time of expiration. As you get farther away from the current date, the price of these will increase. As you can see here, if you go clear up to January, the price of a $60 call is going to have a bid of $8.20, an ask of $9.80, and it last sold for $8.55. However, let's look at something a little cheaper for our example here. So let's say we go to October 30th. So we scroll down and we find our current price. So let's say that we believe on October 30th of 2020 that Caesar will go up to $58. So if we look at the $58 calls, 58 is your strike price, so the price you need the stock to reach for your option to go in the money. As you can tell by these highlighted areas here, these are the calls that are in the money. And what that means is that the current price is higher in the state of a call or lower in the state of a put than the current price. That means that these options have some value. Again, for a call option, it means that you have the ability to buy a stock at the strike price. So let's say we had one contract for a 56 call. That would mean that we would be able to purchase 100 shares of Caesar at $56. With the current price being $57.07, we have some value in that contract. Now same thing with puts. So let's say we had a put option that was at $60. Well, this gives us the ability to sell 100 shares at this strike price. So with the current price being $57.07, being able to sell at 60, we have some value. Alright, so let's jump back into this. So if we look at the $58 call for October 30th, we will see a bid price of 4.05. That pretty much means that the highest price that someone is willing to pay right now is $4.05. Now the highest price on the ask, or the lowest price on the ask I should say, that someone is willing to sell is $5.85. However, most of the time this is a spread. You will be able to get options in between these two prices, especially when the market is open and it's moving around quite a bit. So let's say we were able to secure this call option for $4.70. This is what's known as the premium. So not only do we need the stock to reach $58 by October 30th, but our break-even price is the strike price plus the price we paid, so the $4.70. And that would bring us up to a break-even price of $62.70. So in short, we need the stock to be above $62.70 on October 30th to make sure that we're profitable. So now let's jump over to, let's say, the puts. So let's say that we believe on October 30th, the stock price of Caesar will be below $58. So we'd buy a put option with a strike price of 58. Again, the bid is 475, the ask is 745, and let's say we secured it at 585. So again, same thing with the call options. You have to take your strike price minus the premium you paid, so let's say 585, and that will bring you down to your break-even price. So now not only do we need the shares to be priced below 58, we actually need them all the way down to 52.15 to be profitable on this trade. In short, that's a quick little lesson on things to look at. If you do have any other questions, please comment below and I'll be sure to get back to you. Alright folks, please have your pets spayed or neutered, and I look forward to sharing more knowledge with you. Enjoy the rest of your evening.